Good morning, everyone, and welcome back to our second part of History Lessons and Volatility of our Axiom webinar this morning. My name is Albert Jansen van Vieren from Andile, and as yesterday as well, I'm coming to you directly from my house. And Richard will be doing the same, as all of us are in a lockdown situation in our home. So if a kid comes walking in, if you hear someone screaming in the background, if you hear a dog barking or my neighbor mowing his lawn, we do apologize for that, for Richard as well. Richard, maybe I'll share it with you later on as well, but one of the suggestions that came through yesterday is, can you just ask your children not to be watching Netflix and hog all the internet bandwidth while you are speaking. But welcome to everyone today. Today's session is the second session on the great financial crisis that we're going to talk to you about. Richard, welcome. I see you on mute still.
Oh, thank you, Albert. No, thanks. I'll try and get the children of Netflix, but you must understand how difficult it is. It's a bit of a dog fight at the moment.
Yeah, we're all in the same situation there. Richard will be sharing for us about 40 minutes, after which we will have a Q&A session. Yesterday, there wasn't really any questions that came through, but please today, during this session, you can use the Q&A button at the bottom and you can submit questions. We will not be using the raise hand functionality in Zoom today. Only the questions, and then at the end, Richard will be answering all the questions. What we will be using is the polling functionality. So during the session, there will be a couple of polling questions that will come up. I've just launched one now. So the difficult thing for Richard when he is presenting to you now in a classroom and he can't see your faces, he doesn't really know much of his audience. So as a practice session to get you used to the polling, you can now enter, where were you during the global financial crisis of 07, 08? Were you high school, university, bank? Did you start a company? So just why I added that is, when we started Andile, we started it October 2008, and that was in the middle of the GFC, or we're just none of the above. I'm not seeing any answers coming through, so I don't know if you can see that. Richard, can you see that?
I'm not seeing any poll coming through at this stage, no.
Okay, let me have a quick look and see why that poll, because I just want to test that before we get into the session, that everyone is familiar with the poll. Technically, something is not right there. The poll is not going through. Don't worry about that. We will be, throughout launching other polls to you as well, just a couple of questions that would come through, but please feel free to submit any questions during the session, and then Richard would submit it at the end of the session. Great, thanks, Richard. I'm then going to hand over to yourself.
Thank you, Albert. Let me just quickly share my screen with you guys. Today we're going to be talking about the great financial crisis, which took place from 2007 to 2009. And I mean, high level, what happened was the subprime mortgage market in the United States collapsed. And I mean, what is a subprime mortgage? I think the meaning is there hidden in the name. If you've got something of prime or pristine quality, you've got something of prime quality. Subprime would be less so, less prime. So when normally your prime market is people who are or institutions which are very credit worthy, basically the subprime market would have referred to taking credit risk on people who are less credit worthy than those in the top bracket. And I mean, this crisis was important because it led to the demise of a couple of major Wall Street investment banks, Bear Stearns, Lehman Brothers, Merrill Lynch. You don't really see those names anymore except on the history pages. And it led to bailouts for most of the rest of Wall Street. The US government had to launch their Troubled Asset Relief Program, or TARP, which cost them $700 billion, which is not exactly pocket change. Per IMF reports, the global bank sector took asset write-offs up to the tune of $4 trillion. I mean, in terms of a cost, there's different numbers being bandied about. I've seen anything from 2 trillion to 80 trillion. It sort of just depends on your methodology that you use, because some people say, no, you only look at the bank sector. Others say you need to look at the general economy and job losses in that and losses in production and all of that. But the IMF number basically 4 trillion. So whatever way you look at it, we were all a lot poorer post the crisis. And then the question obviously turns to what caused the global financial crisis. And basically the main problem was aggressive extension of credit in the USA, the biggest economy in the world. And so all the banks and the market was over exuberant. And then the second contributor was the use of securitizations. Bank used securitizations to reduce credit risk. And I mean, it's a very good tool to use and something which banks have utilized a lot in the past. But whereas initially securitization started out with property mortgages, over time the quality of the assets included in those securitization pools deteriorated. But before we get too deep into that, let's just look at how a securitization roughly works. Let's see, there's our first poll coming through. We'll take a look at the answers later on. But basically how securitization works, you have your originator, which can be any bank or any bond originator, and they basically write loans to clients who want to buy houses. And what happens once they get to a certain number, they might want to say, okay, we've written, say, 100 billion rand of loans, and we would like to take that off balance sheet. So what they would do is they would package those loans and they would sell them all to a special purpose vehicle, and the loans would go and sit in there. So they'd sell those loans, they would receive cash, and then the bank or the originator can use that cash to write new business, write new loans to clients, because now they've taken a lot of assets, their lending assets has reduced, so their capital has increased, they've got cash available, they can write more business. And then that special purpose vehicle, one of the requirements is that the credit rating agencies rates that special purpose vehicle and the quality of the paper it issues, because what the SPV does is when it receives those packaged loans, they issue commercial paper and they sell that to investors, and those investors might be pension funds, asset managers, basically anybody wanting or looking for return is in a position to buy that paper if they've got sufficient liquidity available. And basically what will happen is, so the paper will be sold to investors, and as those borrowers repay the capital and the interest on their loans, it will flow into the SPV, and from there it will flow to the investors. And normally what happens is there'll be a servicing agency attached to this SPV, and that is normally your big banks, and they will make sure all the payments come in and distribute the payments as per the rules of that SPV. So as cash comes in from the borrowers, it flows through the SPV and it reaches its end goal, which is the investors, and that's how they get their return. Now, originally, the main problem with securitizations was typically, if you look at the South African housing market, a couple of years back, the average term of repayment was basically 7 years for the average mortgage bond in South Africa to be repaid. And that's normally because people sold the property they were living in, so they get cash and they're able to settle that obligation. And one of the problems with those initial securitizations was, so you buy the paper in this SPV thinking you're going to get a nice return for 20 years, and now after 7 years, someone pays up their loan in full. So now that has a knock-on effect in the pool, and you'll get your initial investment back, and now you have to look for a different investment to get that same yield. So that was more the problem they had with those initial securitizations. So the credit rating agencies who had to rate the paper is normally Moody's, Fitch, and S&P in the US. Those are the three big ones. And the intention behind them having to rate it, that's a regulatory requirement, was that the investors had to have reasonable assurance that they would be able to recoup their investments in these vehicles. And just to give you an idea of the growth in private mortgage-backed securitizations, it grew in the United States from 11 billion in 1984 to over 200 billion in 1994, and then to over 3 trillion in 2007. So massive, massive growth in a very short amount of time. And obviously, as more credit got granted, it sort of fed this whole securitization process. So what sort of happened was the securitization process was working, and because they had proper quality assets in there, everything worked well. And then over time, credit standards started to slacken in the US. And that was due to a couple of reasons. There was political imperatives. The government in the US and the politicians wanted to believe that everyone needs to have the ability to live the American dream, buy a nice house, buy a nice car. And they sort of tried to incentivize banks to lend to people who may be living beyond their means, because they believed everyone had the right to live the American dream. So that was one reason. Then also banks, obviously very competitive and competing in this credit space. So if you refuse to grant someone a loan, there's plenty of other banks they can go to try and raise the cash. And then just in general, the market it was a boom time for real estate. So everyone just thought house prices were going to increase forever in the early 2000s. And over time, some hedge funds started to take a bit of a dim view of the market, and there were few individuals in the banks. I mean, in general, it almost seemed like as this crisis was unfolding, a lot of people was caught unawares. And then obviously afterwards, you'll get a lot of people saying, oh, I foresaw this coming many years ago. But I think the reality is most of the market was sort of caught unawares by this event. But there were a couple of hedge funds early on who started having concerns about the extent of this credit bubble. And I mean, so the hedge funds typically had their analysts and their researchers there on the ground, and they started hearing strange stories when it came to credit extension in the US. Sometimes when they did their research and they spoke to people on the ground, they were telling stories of migrant workers who only work seasonally, earning $14,000 a year, earning approval to buy a house of $750,000. Hairdressers and strippers owning 6 investment properties or 7 investment properties, a whole property portfolio. Now, normally you wouldn't just sort of link those type of professions with property moguls or business moguls, but obviously there's a lot of cash floating around in the system, and it was cheap cash. So this sort of fed the growth of the bond market in the US. And one of the problems was markets and banks seem to have a proper perception that property prices always rise, whereas in reality, everything can go up, but normally nothing goes up in a straight line. So you get these dips. I mean, if you play long-term in the property field, chances are you will make some money, but it's not always a straight up line. Property prices can fall or grow negatively as well. So, as I mentioned, they had all these securitization assets. So at the start, it mostly consisted of property mortgages. And then they started to feed some other assets into this pool, which included assets like vehicle finance, credit card debt. Personal loans started flowing into these pools. And quite often what the banks did, they asked their clients to refinance. So the interest rates dropped. They said, oh, let's refinance your loan. Or they say to them, let's consolidate all your vehicle finance, your credit card debt, and your personal loans. We consolidate that, and we sort of hold your property as collateral against that. And then you can either take out a second mortgage or we refinance your mortgage. And this was sort of all good and well, as long as property prices kept on increasing. I mean, another interesting thing about the US, if you're a homeowner there, and you can no longer pay the installment on your loan. Normally what you do, you just take your keys and you put it in the mailbox outside and you leave, and it becomes the bank's problem. So if their loan was $400,000 and they're only able to sell the house for $300,000 in auction, they weren't allowed to sue you for that difference of $100,000. Now, unfortunately, in South Africa, we don't have the luxury of that. If there's a shortfall once they've auctioned off your house, you are still liable for that number. But that sort of gives you an idea as to why people didn't really think about loading up on credit that much. The consequences weren't always there. So, collateralized debt obligations, when the Wall Street banks started including all these other type of credit assets in these pools, I mean, there's a simple reason for it. All these CDOs that they packaged and sold have made massive profits. And they really started to create more and more of this, and Wall Street made a big part of their revenue was linked linked to these collateral debt obligations. So the question was, why did the credit rating agencies keep on rating tranches of these CDOs at A and B levels? I mean, so this next diagram basically is another securitization, because a CDO is actually just a different form of securitization. It's just your assets. So if you look at this one, the customers year linked to the originator year, it was car, house, equipment, on installment sales and finance plans. And here's this a special purpose vehicle in which paper is sold to investors, but here you can see the tranching that gets done here. So here the asset pools have been broken up into a senior section, mezzanine, subordinate, and equity portions. And typically what happened is you get ratings on the two top levels and maybe on the third level as well, and the equity level would not be rated at all. So as you go up this food chain, your risk decreases. So your equity portion carries the most risk, but because of that, it got the highest interest rate. Subordinate level carries less risk, but it'll have a lower interest rate than equity. Same for mezzanine, and so on. And so the strange thing is, although all these dodgy assets were sitting on these CDOs, the credit rating agencies kept on giving stellar ratings to these CDOs. And there's a couple of reasons why that happened. One of the big drivers was actually the people working on Wall Street were not always nice people. They looked down on these guys working at the credit rating agencies. They thought they were better than them. There was a common saying, people who can't find jobs on Wall Street find jobs in credit rating agencies. So there's a real arrogance from the banks towards these agencies. And because they sort of had a good idea of how the models worked at these credit rating agencies, the banks actively tried to game the system. I mean, a simple example of that would be the use of Fico Scores, which is basically the credit scores in the US. And roughly how it works, the credit score you can have on those Fico Scores is that the max score is 800, a minimum score is 300. The minimum means you're not credit worthy at all. And if you do a cross-cutting across the US, the median score was 723. And how it worked in these pools, to get the highest possible rating, they required an average score of 615 in this pool. So when the credit rating agencies, when the bank brought this new SPV with paper that they wanted to issue, they just gave high-level details about the assets in the pool. It's not like the credit rating agency did a proper drill down and rate individual loans within the pool. They asked for certain pool characteristics, and they sort of had a model which worked out the rating based on those characteristics. And this Fico score was one of the inputs. And if you had managed to obtain an average Fico score of 615 in the pool, you would get the highest possible rating, which would have been A. So what the investment bank started doing was they started mixing and matching Fico scores in there, because if you just look at it, if all the individual loans sitting in a pool had a Fico score of 615, the risk would have been much less than if half the loans in the pool had Fico scores of close to 700 and the other half close to 520. Because with a score of 520, it is almost guaranteed that at some level in the next couple of years that you'll get default on that quality of asset. Whereas on 615, that risk is very little. But now when you combine those risks to get an average score of 615, your credit risk is much greater than if all the individual assets in that had a rating of 650. So as long as they had sufficient number of good payers to bring up people below that average payment, they could still get a very high rating from a Fico perspective, which would lead to an A rating for that tranche. So the other thing that the credit agencies also didn't take into account is that those Fico scores can sort of be gamed. I mean, your income wasn't even part of a Fico score. And the other problem was they had what they called thick file Fico scores and thin file Fico scores. So a thick file refers to that you've got a long credit history and a lot of detail, whereas on a thin Fico score, there wasn't much credit history. So someone may have never missed a repayment because they've never had a loan, and that left them with a surprisingly good Fico score. So when the bank started realizing that, they started asking the originators to actively load the pools they were selling with thin Fico score assets, because it would cost the banks less, and then they could package the CDO and make a lot of money on the fees, but the raw materials to generate the CDO was cheaper than it would normally be if they just used a higher average score per individual in the pool. I mentioned that agencies would rate the securities based on the uniform characteristics of a pool. They wouldn't look at the individual loans. And the other problem was in the market in the US, all the CDOs rated at A sold at the same price. All the CDOs rated at B sold at the same price, and so on. But if you actually went through the effort of looking at the breakdown of the individual loan sitting in the pool, there was massive differences. So you'd get pools with a lot of people with low Fico scores offset by a couple of high scores and that type of thing. So there's big differences in those pools. So it didn't really make much sense to rate them all the same and for those securities to be sold at the same price. Other problem was obviously a bit of a conflict of interest. So the issue of the security was the one paying for the rating. So the problem from a credit rating agency perspective is they didn't rate it high enough or give a rating that the bank wanted. They told them, look, we'll just go elsewhere. We'll go speak to one of the other agencies to rate that bond. So you've got a bit of an inherent conflict of interest there. And then later on, as this credit monster kept on growing and growing, and more complex securities was pushed into the market, banks often started submitting their own models of what the risk was attached to these pools, and then the agencies would just validate those models. So there was a lot of conflicts of interest in this industry. Albert, can you maybe quickly show us those polling question results? So our question was, do you think the South African Reserve Bank has done enough to protect the SA economy against the impact of COVID-19? 20% says yes, bring on the economic consequence. I always enjoy the optimists a bit more than the pessimists. Time for them to start showing their hand. Yeah, 20% there. They do not have ammo to make much of a difference. 36% there. And yeah, then the real gloomy people, the real pessimists. No central bank in the world has enough ammo for this. So yeah, interesting times ahead, and let's hope the optimists triumph in this one. So I mentioned banks started issuing CDOs, and what sort of happened after a while was that they started issuing so many CDOs that they started running out of raw materials, which was loans to customers. So there was a massive demand for originators to bring loans or package loans to the Wall Street banks, because that way they could generate CDOs. And obviously the more loan pools that the banks want to buy, the more lax credit standards gets, and the more credit they push out into the market. Now, I mentioned some of the scores or some of the loans didn't even require you to give evidence of the income that you earned. So that just makes it very easy to grant credit, and that just feeds this bubble even more and more. So what the banks started doing, as they were struggling to get sufficient raw materials to keep on creating CDOs, they started experimenting. And they started experimenting with things like synthetic collateralized debt obligations, CDO squared. And first off, we'll take a look at synthetic CDOs. So what started happening, they started selling credit default swaps as the assets in these pools. So rather than having bought pools of assets where people repay the installments on a monthly basis, they repay their capital and their interest, they started selling credit default swaps, and the premiums on those would be the revenue generated through the special purpose vehicle, and that would reach the end investor. Now, this was controversial because what could happen by issuing CDS, it created a vehicle for hedge funds and a small number of traders on Wall Street to bet against the subprime market, because they could start shorting the subprime market by buying these credit default swaps. Maybe I'll just quickly jump in just to give you an idea of how a credit default swap works. So here we've got a protection seller, and a protection buyer. And normally what happens, your protection buyer will normally own bonds in a corporation. So let's say Corporation Z, and they've bought bonds from Corporation Z of $100 million. They are concerned that Corporation Z is going to default on their obligation. So B could just go to the protection seller and say, can I please buy a credit default swap referencing Corporation Z for a notional value of $100 million. To have as protection, I'll pay you installments on an annual basis, and that'll normally be linked to LIBOR. So it'll be LIBOR plus 0.5% or something like that, depending on the credit rating of a referenced entity. So in a way, it's a form of insurance. Like you buy insurance for your car, so if there's a car crash, you get money so you can buy a new car. This is roughly how a credit default swap works. You've got bonds, you're concerned that the bonds are going to get damaged in some accident. You ask the protection seller, can he sell you some insurance on that? You'll pay them a premium. And if something happens, the protection seller has to make good the value of a bond you had purchased. So quite a large buyer of credit or seller of credit default swaps in the market was AIG, the American Insurance Group. And they bought up massive quantities of, sold massive quantities of CDS. And the interesting thing is most of the market makers in that space were buying and selling credit swaps. So at least they had a smaller net risk position because they were buying and selling credit default swaps, whereas AIG was literally just selling credit default swaps. So they built up quite a massive, big gross credit exposure of $20 billion to the subprime market. And it reached a level where they actually said, look, we're not willing to take on any further risk. We'll honor the contracts we've got in place, but we're not going to sell any more credit default swaps. When they did this back in 2005, when they made that decision, they were making $300 million a year. So 15 to 20% of their annual revenue came from selling these credit default swaps. And for a lot of time, people just saw selling a CDS as getting money for nothing, because bad things do not happen in the real estate market or in the property market. And later on, these credit default swaps they would sell would have some severe consequences for AIG. And actually, when AIG made the decision to stop selling CDS, a lot of the traders who had shorted, and a lot of hedge funds who had shorted the subprime market actually thought this was going to stop the subprime market dead in its tracks. But what tended to happen was that business just went to other Wall Street banks who started being more aggressive when it came to selling credit default swaps, because they had quite a positive view of the subprime market. So when it came to synthetic CDOs, and let's actually have a quick look, this is just a breakdown of the cash flows on a normal CDO as opposed to a synthetic CDO. So here you've got actual loans sitting in the asset pools. So as the borrowers repay the capital and the interest, it flows to the special purpose vehicle who owns the owners of the asset-backed security paper. Whereas on a synthetic CDO, here it is the premiums received from CDS holders. That goes into a special purpose vehicle and eventually finds its way to the owners of the paper. So you can imagine once defaults on reference entities start happening in the market, all of a sudden those premiums would dry up. And these investors or owners of this paper in the synthetic CDO would be left hung out to dry and suffer big losses. The other one I mentioned was CDO squared. So this is where it gets really messy. So what they started doing was, as they looked for raw materials to build these CDOs on, they started taking pieces of other CDOs. So you could have a bank issuing, say, 7 CDOs, and CDO 1 would have pieces of CDO 2, 2 would have pieces of 3, 3 would have pieces of 4, 4 would have pieces of 5, and then 5 would have pieces of 1 and 3 in there. So it's almost like a circular Excel reference. So, I mean, some of the financial engineering which went into this sort of beggars belief. But, yeah, I mean, we had a look. So the synthetic CDO issuance from $15 billion to $61 billion in the space of a year. I mean, it was nothing else but a feeding frenzy. So this asset was building and building, and it wasn't going to be long before it exploded. So to give you an idea of how tough it is actually sometimes to read financial markets, it's useful to look at the story of Howie, Hubler, and Morgan Stanley. And So you had these hedge funds who shorted the subprime market, and they sort of all had the view that the day of reckoning for subprime market would come when property price growth either stops or went negative. That would be the day when this market starts falling apart. And the interesting thing about the story about Morgan Stanley was Howie Hubler actually had quite a dim view of the subprime market. Before, he'd made quite a lot of money of it. He'd built a whole business out of it. He was basically making $25 million a year in salary and bonuses out of the subprime market. But towards the end of 2004, he had sort of grown cynical of subprime mortgages. And he thought it wasn't going to be long before something bad happens in the market. So to protect himself and take advantage of this opportunity he spotted in the market, he started buying up credit default swaps on subprime mortgages rated BBB. And he bought about $2 billion of CDS on B-rated subprime exposures. But now the problem is when you buy protection, you of course have to pay these premiums. And these premiums was expensive. It cost them about $200 million a year out of their budget for $2 billion for his trading division. So about 10% budget was spent on putting in place this CDS position. And at that stage, the rate for B-rated securities was about LIBOR plus 2.5% per annum. So it was expensive, but he liked having this trade on the books because he believed it was going to pay off in a big way somewhere in the future. But after a while, it became so expensive that he needed to start to fund these premiums. So what he started doing was he started selling credit default swaps on A-rated subprime exposures. So the only drawback of that was because it was A-rated, your premiums was quite a lot less, about 1/10 of the premiums on the B-rated securities. So if he was paying LIBOR plus 2.5% on the B-rated securities for protection, to sell them, he was only getting about LIBOR plus 0.25%. So in order to match this $200 million worth of inflow, he had to sell a lot more CDS on those A-rated securities because the premiums were much smaller, and he ended up selling $16 billion worth of CDS exposure on the A-rated securities. So although the premiums roughly netted off, on the upside, he could only potentially pick up $2 billion, but on the downside, he could lose up to $16 billion a year. He could incur a loss of $16 billion. So the risk management at Morgan Stanley started getting concerned about this, and they sort of asked Hubler's bond trading team to start doing some stress tests on their bond trading portfolio. And at that stage, the stress test they like to do was just a 6% default rate in the subprime space, which at that stage was the worst losses subprime market had ever incurred. And in that space, it sort of showed them making money on the CDS that they had bought on the B-rated securities. But then the chief risk officer wasn't too happy with those results. And he said, look, 6% is quite high, but I've seen some analysts on Wall Street who has a much more cynical view of the subprime market. And they're pricing for a potential 10% default in that subprime space. And at first, this bond trading team didn't want to do that stress test at all. And for 2 weeks, they kept the risk department at bay. And they said, look, this is an impossible scenario. If there's a 10% default in the subprime mortgage market, we're going to have 1 million people in the US living on the streets. Something which they thought to be true, but if you think back about the example of a hairdresser having a portfolio of 6 properties, a lot of the property market was driven by speculations. It wasn't necessarily people buying houses to live in. It was to speculate. So that's also why that assumption didn't necessarily hold true. So they did that test of a 10% default rate. And this showed potential losses of $3 or $4 billion. And naturally, when the credit department saw that, they weren't overly happy with Howie, Hubler, and Morgan Stanley. And so towards June 2007, a couple of weeks before, they actually, as part of selling the CDS on the A-rated securities, they sold quite a chunk of that to Deutsche Bank of $3 billion exposure. And Deutsche Bank in June 2007 actually asked for margin of $1.2 billion on these CDSs that they purchased from Morgan Stanley. And there was quite a big debate because their models were showing, the Deutsche Bank models were showing the subprime exposures were only worth 70% of a face value, and Morgan Stanley was saying they'll be 95%. But it was clear that something was about to break. So the first margin call was for $1.2 billion. The next one was $1.5 billion. And very soon, Howie Hubler wasn't working for Morgan Stanley anymore. He ended up losing $9 billion on those CDS trades, which he had put on book. At that stage, that was the biggest trading loss in the history of Wall Street at the time. And that sort of shows how finicky it can be to bet on financial markets, because here Howie Hubler had sort of a right view. He doubted that things could continue as they had been in the subprime market. He thought there was going to be a blow up, but there's two things he wasn't sure of. He wasn't sure when it was going to happen, so he had to keep on paying these premiums on the CDS all the time. And the other thing he got wrong, he wasn't sure about the quantum of his losses, because what ended up happening, they didn't even want to do that stress test, which shows 10% of losses in the subprime market. Actual losses on the pools that he had sold securities on in the end ran up to 40%. So he had massively underestimated the extent of a subprime blowout. And it ended up costing Morgan Stanley a lot of cash. So basically, for that quarter, when they did their quarterly reporting, they didn't have a profit at all, because all the profit made by the other 50,000 JP Morgan employees was lost against this $9 billion trading loss by their bond trading team. And that sort of just shows you it is very difficult to predict what's going to happen in financial markets. So as borrowers started defaulting on their obligations, when the real estate market turned negative, the whole pack of cards came tumbling down. Even the most highly rated AAA tranches of subprime exposure started suffering losses. Bear Stearns, who had been trading at $133 per share 12 months ago, collapsed and was sold to JP Morgan for $10 a share. Lehman Brothers peaked at the market capitalization of $60 billion a while before, or $86 per share, took a massive hammering in the subprime crisis and had to file for bankruptcy, the largest in US history at the time. And that was on the 15th of September 2008. And Merrill Lynch agreed to be acquired by the Bank of America basically on the same weekend that Lehman collapsed. So this had a massive impact on the financial markets. If you remember, if you sat in yesterday's session, we spoke about when long-term capital management had to be bailed out and how Lehman Brothers and Bear Stearns didn't want to be contribute. Well, in the end, this was the price they had to pay, not the $300 million back in 1998, but basically ceasing to exist in 2008. So of course, when it reached these levels, and now there was a major risk that all the banks on Wall Street could collapse, the US government had to step in. They launched their TARP program, or the Troubled Asset Relief Program, a rescue package of $700 billion to save the big Wall Street banks. So AIG was a big seller of CDS on subprime mortgages, received at first $85 billion to bail that out, and then that wasn't quite enough, so that number actually went up to $182 billion in the end. And of course, this bailout once again generated enormous amounts of controversy because the government seemed to be bailing out rich bankers. So it wasn't a popular move from a public perception perspective. On this next slide, I'm just going to show you an actual breakdown of CDO issued. So this was when they held hearings in the US government about the subprime crisis. This was one of the things they had to look at. So this is basically a cross-cut of the CDO that was issued. And here you can sort of see the different tranches to the left. So here you've got your senior tranche, your mezzanine tranche, and your equity tranche. So senior 78%, mezzanine 21%, equity 1%. And sort of here shows you the balances of those pools, the ratings, and you can see the spread. And the spread is the spread above the LIBOR rate at that time, which was 5.32% when they issued this vehicle. So on the top tranche, it paid LIBOR 5.32 plus 0.14. And you can see as you go down to the lower rated securities, you can see the increase in spreads. So you got paid about 7 0.8% for holding a mezzanine tranche, as opposed to 5.6% for holding a senior piece of debt. And the investors, so obviously because the paper tended to be rated so highly, you had a lot of pension funds, a lot of international investors actively looking for the return on this paper. So it wasn't a difficult sell from a bank perspective. But yeah, obviously, if the credit rating agencies hadn't rated these paper that highly, there wouldn't have been as big a take-up from the investors. So if we look back, I mean, the main driver of this crisis, basically over-exuberance and granting credit. Other problem, and this we had a look at yesterday with long-term capital management as well, was very high leverage in the banking system. Bear Stearns was leveraged 40-1, Merrill Lynch 32-1, Morgan and Stanley and Citigroup both at 33-1. And yesterday when we looked at long-term, they aimed for leverage of about 30-1. So you can see not too many lessons learned from the long-term debacle all that time ago. And I mean, one of the other problems, so not only did the big banks package and sell off the CDO paper to the investors, quite often they bought pieces of paper themselves. So almost sort of getting high on their own stash that they were selling to the rest of the market. Another reason for this, Wall Street traders and CEO did not always understand the risks that they were exposing the banks to. So you've got complexity because, I mean, we sort of try to have a very simplified look at what happened in those CDOs. But when you really start digging, you can see it was some very complex instruments, which is why your credit agencies struggle to really drill down into the details of these CDOs to see what is sitting in there. So by making it complex, now people do not fully understand it. They're not asking the right questions. And you've even got traders who's speculating on this market, not really understanding the full risk behind this market. And you combine all of that with high leverage, and it's not long before you've got an explosion of nuclear proportions. Obviously, the other problem, credit agencies not rating the CDOs in line with the risk that they expose investors to, and banks actively gaming those credit rating agency models. So, I mean, there's the sources which I used. But I'm going to hand back to Albert now. That is basically our story on the financial crisis of 2007 and 2008. Albert, I'll hand back to you now.
Thanks, Richard. You're not going to hand back to me because there's some good questions that came through which you are going to have to answer. So
I'll try my best.
Yeah. No, it's good. So just the first question that came through, I don't know if you can see it, is which credit ratings are deemed to be subprime?
Also, basically, if you look at the portions of those tranches, the equity in the lower pieces quite often weren't rated at all. So basically, what started happening by mixing up a lot of highly rated assets or people with large credit scores, which is not expected to default with these subprime pieces or messy pieces, what the banks tried to do was to sort of say, look, you will have some losses in the subprime market, but because we're mixing that with all these proper quality pieces of credit, that is diversifying our credit pool. Because we're not expecting all the subprime mortgages to default at the same time. But what they didn't sort of realize was the close correlation between the subprime market, that they've extended so much credit that any downturn in the credit market basically was going to be like a fire that runs through that subprime market. Those instruments were a lot more closely correlated to each other than they expected. So, I mean, pure subprime wouldn't normally actually attract a rating. But by mixing subprime mortgages with more highly rated assets, the banks sort of gave a perception to the credit rating agencies that now they've turned rusty metal into gold.
Okay. I'm going to give you an easy one now. Here are the results from our last poll, which you can maybe talk through.
Oh,
interesting to see the results that came through. About half of the audience, well, yeah, less than half of the audience voted here, and you can see some of the results there.
Okay, so the question was, do we believe any of the commercial banks within our country have been guilty of designing and implementing products or trades where they do not fully understand the risks it exposes the bank to? Unfortunately, none of them seem to be banking saints. Now, then there's one, I can think of one or two banks where they may have overextended themselves. Yeah, I think that's probably a good answer. And then we've got the pessimists. Pessimists are out in force again. The problem is more widespread than we think. And then there's quite a few also saying banks stick to the basics. I think in general, the South African market has been more conservative. We had exchange control, and in a way that sort of protected the South African market because it just meant we weren't able to eagerly invest in as much subprime paper as the rest of the banking world had. So I agree, even though one or two did get themselves into trouble, I think we were a lot more well behaved, and especially from a leverage perspective, we were not nearly as aggressive as some of our international counterparts.
And the same answer for the rest of Africa?
Well, the rest of Africa, I think obviously the banking sector is quite different from the more mature type markets as opposed to the emerging markets. So they would have felt the knock-on effect, but I don't think I've seen an African bank which was very heavily involved in some of the subprime mortgages directly. There's more sort of a knockdown impact of less liquidity in the market and the trickle-down effect that had on the banks in your emerging market space.
Yeah. I've got a couple of more questions that came through here, and the next one is, will credit rating credibility be called into doubt under the current economical and physical circumstances?
Yeah, I mean, that is actually a very good question, because if you sort of think what the central banks, the global central banks, what they're doing in response to COVID-19 is basically a lot of quantitative easing, pushing a lot of liquidity and cash into the market. So in a way, because everyone is doing that, that's at risk of pushing inflation in, and it's putting the value of your currencies at risk. And I mean, once you start doubting the value of your currencies, then I'm not too sure a credit rating is going to be too much help to you.
Yeah. Next question that was related to the poll we had earlier around the South African Reserve Bank. And the question is, so I'm just sharing those results again, but it was, Richard, in your opinion on the polling question, do you think that the South African Reserve Bank has enough ammo to conquer COVID-19 induced economic crisis? And what is your foresight for the South African economy? No pressure.
Yeah, I mean, that is a very interesting question. If I look back at long-term capital management in '98 and the financial crisis, the GFC in 2007 and 2008, there you had this problem where banks were got ahead of themselves, not a little bit, they got ahead of themselves a lot, and they were very aggressive in pushing credit. And because of a banking implosion, that had a knock-on effect on the economy. This COVID-19 thing is very different in here. We've actually got the global economy being stopped in its tracks, something which probably hasn't been seen since the Second World War. And even if you think back to the Second World War, the British had a very popular slogan, keep calm and carry on. Now the slogan is keep calm and do nothing. So here we've got the very real risk that you've got a massive economic hemorrhage which is going to feed over to your banking system. And what that means for banking system in general, I don't think anyone really knows the answer. So in terms of that poll, I would probably be closer to, unfortunately, the pessimists in that one and say, probably no central bank in the world has enough ammo for this, because the solution is going to be let's print more cash. And you can only do that to a certain level. I mean, that's what Venezuela and Zimbabwe did. And the result there wasn't pretty. So, I mean, it's difficult to make predictions. Hopefully, they can find solutions sustainable solutions. And hopefully it's not a case of throwing the baby out with the bathwater. Because if you've got a massive global systemic banking event, there's not going to be much of a place to hide.
Yeah.
But I suppose hope for the best, plan for the worst.
That's very true. I've got one more question, unless I'm still going to leave it open if anyone wants to submit more questions. But the next question is, how did this credit crisis, which you spoke about, show that banks were also underestimating how even good quality assets could not be sold or bought in the midst of a credit blowout?
Yeah, I think so. What the credit rating agency sort of said was the market was viewing their credit agencies as a measure of liquidity and market risk as well, which it wasn't. So, sorry, maybe just quickly revisit that question. I sort of got ahead of myself. Just quickly repeat the question.
Yeah, I think you should maybe you can see the Q&A. If you open up, you should be able to see the question is, Albert. It's how did the credit crisis show the banks were also underestimating how even good quality assets could not be bought or sold in the midst of the blowout?
Yeah, so I think obviously the banks were very reliant on the credit ratings, and I think what Basel has sort of tried to do was enforce post the crisis on banks that they had to do their credit analysis a lot more and not just blindly rely on what the credit rating agencies were giving them, because the banks, they've got big balance sheets, so they've got analysts, they've got people who can take a look at the credit risk, plus they know their own exposures. So quite often, they should have a better view of credit risk than the credit rating agencies can actually do themselves. So what sort of happened is they just blindly relying on what the credit rating agencies told them, even though they know their own traders and their own bankers are gaming the system. You have got the recipe for disaster. But I suppose the problem with the credit rating agencies, yes, it's highly regarded, but at the end of the day, it's just an opinion. It is like using value at risk for market risk. They're 99 or 98% certain of what the losses are going to be, but they can never give you a 100% answer. So you've always, when you use that ratings, you've always got to use that with a pinch of salt, or there's no such thing as no risk. So you've got to be careful of overextending yourself based on a rating that a third party does and receive money on.
Great. We've got no more questions here, Richard. Before we finish, any closing thoughts, remarks from yourself?
No, just thanks everyone for tuning in. It's been a pleasure, and be sure to tune in for our next sessions next week and the week thereafter.
Yes, thanks, Richard. Appreciate that. So, yeah, as Richard mentioned, this was the last session of a two-part session. If you have any questions or would like to speak to Richard, you can email us on axiom@andilesolutions.com. If you've got any suggestions or any topics or anything in particular you might want to talk about, you can just email us. So, like Richard said, we've got 3 more sessions coming up during the month of April. So the next session would be on the 15th of April, 11 a.m. South African Standard Time again, where Milan Mehari, our in-house accounting specialist, will just be talking to us around, well, demystifying accounting in a capital markets world. And then after that, we've got Craig Edwards from Australia, who's going to talk to us about DevOps, and finishing off with a blockchain delivery versus payment using a distributed ledger technology. So thank you very much, everyone, for dialing in again today. If you've got any questions, please email us, axiom@andilesolutions.com. We are recording these sessions, so if you would like access to the recording, you can just email us as well. Have a good Easter weekend, and we'll speak again next week. Thank you, everyone.